Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today is September 2nd, 2025, and today on our call we have the CEO, Hugo Alves from Auxly Cannabis. Auxly trades on the TSX, the Toronto Stock Exchange, under the symbol XLY, and it also trades on the OTC under CBWTF. The company is currently trading at 15 cents with about 1.34 billion shares outstanding, or about a $201 million market cap. I'd now like to hand it over to Paul Andriola.
Hey, thanks a lot, Trevor. Hugo, great to have you here. Appreciate the time you're going to give us today. You are one of those rare companies in the cannabis space that's actually making money, the kind that we like. So happy to have you tell us why that's happening, what you guys are doing right, and anything you can about the business. So I'm going to hand it over to you and let you start your presentation.
Well, that's great. First of all, thank you, Paul. Thank you, Trevor, for having us on the show, and thank you also to your audience for tuning in. I'm going to be fairly high level. I am going to share my screen here to give your viewers a little something to follow along with. As you've already stated, Auxly is a publicly traded cannabis company based in Toronto. We're listed on the TSX stock exchange under the ticker XLY and the OTC/QB exchange under the ticker CBWTF. We are the third largest producer of cannabis products in Canada with about a 6.2% share of total market. And importantly, as you mentioned, we are growing profitably. Over the last 12 months, we've generated approximately $139 million in net revenue, about $38 million in adjusted EBITDA, and about $28 million in net income during that period. Our flagship brand, Back 40, is the #1 cannabis brand in Canada by dollars sold. It is trusted and loved by consumers from coast to coast. And our products are present in 97% of all retail locations across the country because we focus on the formats that matter most: dried flower, pre-rolls, and vapes. Collectively, they make up nearly 90% of all cannabis sales in Canada. And because of that focus, we are recognized innovation leaders in each of those formats, consistently producing winning innovations to delight our consumers. And we own two strategic assets that really give us an edge. Okay? Auxly Leamington, our 1.1 million square foot cultivation facility, is one of the largest and most advanced cannabis cultivation facilities in the world. In Auxly Charlottetown, our hub of product innovation and vape manufacturing is second to none when it comes to cannabis vapes. And I think those assets give us a real strategic advantage. They give us unmatched advantages in quality, efficiency, scale, and product leadership. And we've also recently recapitalized and today have a very strong balance sheet, strong cash flows, and the support of Imperial Brands, our strategic partner that owns approximately 20% of our stock. So we're really excited for the future of the company because we believe that combination of market leadership, profitability, and financial strength really positions Auxly to keep growing profitably and leading here at home, while also preparing us for future global growth. So in short, Auxly makes cannabis products and brands that consumers truly love. We're growing profitably, and we're excited about the future of the business because we believe we are just getting started. And a couple of more recent updates. We recently released our Q2 results, our Q2 25 results on August 14th. And it was really a record quarter for net revenue. We generated $38.8 million in net revenue after excise tax. That's a 33% year-over-year growth. Gross margins of 52%. That's a full 11 basis points higher than last year. And we grew adjusted EBITDA to $11.6 million, which is a 30% margin and 123% year-over-year increase. We also generated about $8.3 million in net income, $4 million of cash flow, and we finished the quarter with $17 million in cash. I'm really proud of the team for achieving those results, all 410 Auxly teammates. And I think those results validate that our strategy is working. Our strategy of focusing on the largest, fastest growing consumer segments, earning the trust and love of consumers through consistent quality product and innovation, and delivering those products profitably through purpose-built, efficient operations at scale. I think those capabilities, coupled with our culture of teamwork and continuous improvement and our obsession with route to market excellence, that strategy is delivering CPG style performance, and I think really underscores our excitement for the future of the company. And then also, very importantly, immediately subsequent to quarter end, we accomplished a major recapitalization with strong support from our senior lending syndicate led by BMO and our strategic partner Imperial Brands. Effectively, we eliminated $21 million of debt from our balance sheet through the Imperial Brands debt conversion. We reduced our debt servicing costs by about $700,000 a year. We acquired an additional $10 million of available credit to help us fund future growth. But most importantly, we really flipped our working capital from a negative working capital position to $35 million in pro forma working capital. So this really transformed our balance sheet. It really fortified our foundations for continued growth. And it gave us the confidence to remove the going concern uncertainty note from our statements once and for all. So it was, I think, a transformative quarter for Auxly. We got a lot done. It was a full team effort, and I could not be prouder of the team. So that, I think, is really Auxly in a nutshell, along with kind of our recent performance. And I'll turn it back over to you, Paul. Look forward to answering questions from you and your viewers.
Excellent. Thank you so much, Hugo. Yeah, reminder for those listening, if you've got some questions, and I see a few are starting to show up here, please use the chat function and we can ask those questions. So you mentioned some of your products, Top 40 being, or sorry, Back 40 being one of the top brands out there. Maybe like what other brands, or what is your top selling products in all the different categories? Let's talk a little bit about where you're seeing that success.
Yeah, great. Look, I think maybe I'll answer that question a little bit differently, because I think it's something that investors actually miss about our story, right? I think, investors, some of your audience may be aware of our sort of commercial and financial performance. As I mentioned, over the last 12 months, we've generated a significant amount of net revenue and earnings and net income. But I think what investors miss a lot is that we are achieving those results with far fewer SKUs than any other company in the top 5, top 7 LPs, right? In fact, when you compare Auxly to the companies that we're chasing, the companies above us, they're operating with 2 to 4 times our SKU count, right? And I think the type of portfolio efficiency that we have really speaks to the consistency and quality of our products, the strength of our innovation, and our route to market excellence. We're consistently putting out products that consumers love, and they're not just flashes in the pan. They're becoming consumer favorites. And as a result of that, our Back 40 brand is earning the trust and loyalty of consumers. And I want to give you a data point to really drive this home. If you look at total market on a SKU basis, okay, so we're talking every SKU in the Canadian cannabis market, coast to coast, and you look at the top 30 SKUs, these are the SKUs that really move the needle, generating from $1 million to just shy of $3 million at the till sales on a monthly basis. If you look at those top 30 SKUs, 7 of them are Back 40 branded products. So 23% of the industry's hardest working SKUs are Back 40 branded SKUs. No other brand in the country even comes close. In fact, no other company has 7 SKUs in the top 30 SKUs. So I think investors miss sometimes that not only are we having commercial success and financial success, but we are accomplishing that with the most effective and efficient product portfolio in the industry. And again, really underscoring our product quality, the consistency of our product quality, and the strength of our innovation and route to market.
Hugo, I mean, we've seen the industry has kind of been littered with, let's say, weaker execution of business models. Maybe let's talk about the team that's doing this right now. What's your background? What's the rest of sort of the key members' background as well?
Yeah, sure. My background is I'm a lawyer by training. I was a business lawyer and a senior partner at Bennett Jones, a national law firm here in Canada. I was also, along with one of my co-founders, Mike Lickfer, our president, we really built the cannabis business at the law firm. We're really the first legal team to get into cannabis. We developed a very large practice there, and then eventually we saw an opportunity to join industry and get into market. And we, with the blessing of our respective families, decided to take a chance, take a risk. Effectively, we asked ourselves, we love cannabis. That's why we got into the industry. We're big believers in the power of the plant. We had a great reputation. We acted for about 70% of all market participants at the time. So if not those conditions, to take a risk from a very lucrative and well-established career, what conditions would have to exist? And we didn't want to live with the regret. We wanted to really give it a go. So myself and Mike, we have legal backgrounds. Our chief commercial officer comes from a commercial background. He was actually the former CEO of the PEI Liquor Control Board. So a lot of experience dealing with government distributors and also retail. Travis, our CFO, comes from a financial background. He was an investment banker. He worked at a Big Four audit firm, and he was actually employee number 1, the first person we ever hired at Auxly. So our executive team, we come all from professional services backgrounds. And I think, we're students first and foremost. So, even though we didn't come to this industry with a CPG background, we're very good at learning, adapting, and getting up to speed very quickly. And I think we've done that over the 8 years that we've been at Auxly.
Mm-hmm. And it's always interesting to watch like a new industry like this, develop. And I imagine you've learned a lot in the 8 years that you've been at it. Is there something that really stands out that you think was an aha moment, or something that that you guys figured out that's had a bigger impact than others?
Yeah, for sure. I think when we came into the industry, it was on right at the sort of end of anything is possible and everything is possible, and this is going to be the opportunity of a lifetime. We still believe it is, that the cannabis opportunity is great. And I think, like all cannabis companies during that time that had access to capital, and the market very much rewarded transactions and new facilities and things like that, we ran into challenges. And I think we ran into fewer challenges. Like we didn't get ourselves into as big of a problem with lots of facilities all over the place. But I think what we've learned is really the power of focus, and we've learned a lot of lessons navigating the challenges and the headwinds and the financial difficulties. So I think those challenges, they say tough times create strong people, they create strong companies as well. I think going through the hardships and the headwinds, our balance sheet weakness and the challenges to our liquidity, it forced us to focus intently on what matters most and not get distracted by noise, right? So we focused on the product formats that mattered most. We focused on the assets and capabilities that we needed and nothing else. And we focused, instead of trying to be number one in market, we focused on efficiency and gross margin dollars as the proxy for our success. And I think that, it really created an organization that's determined and resilient and united. So I think what we've learned is you need to focus on only what matters, cut out all the other noise, and then be great at those things. And I think we are great at dried flower. We're great at pre-rolls. We're great at vapes. And we have a very, very strong team that has been battle hardened, that has been through the hardships and stayed united. I think a lot of other teams that are not founder teams, that are not super early employees, going through, we went through from 22 to 24, I think a lot of people relent, and we weren't prepared to do that.
Now, you guys, clearly have learned a number of things, having seen the gyrations in the industry. But I saw in the last press release, you mentioned tailwinds. Now, the industry is obviously significantly better, I'll say, than it was before. But maybe describe some of the tailwinds that you guys are now starting to see within the industry and specific to your business.
Yeah, so we are seeing some tailwinds in pricing. I think I think your viewers are probably aware of that. If you've seen some of the other interviews. So, look, demand for cannabis at an all-time high. Domestic demand is growing, international demand is growing, so that has had an impact on price for sure. And it's enhanced the financial performance of some producers. But I think some of the other things that maybe are not as obvious that flow from that for your viewers are, those demand dynamics have really enabled the owners of large scale cultivation assets to really start to dominate the high volume, segments, large flower formats, 28-gram bags, which, are, if you look at those top SKUs, right? They're the ones that generate the most revenue. And I think as flower prices have increased, if you were kind of in the middle, operating on an asset-light basis, so you have to buy flower from a producer, repackage, rebrand, and sell, it is very unlikely that you're going to have the margin room to compete effectively or profitably with Auxly. Right? You just can't offer the same value. So I think that pricing increase has seen, owners of these assets rightfully start to dominate those segments. And I think the other thing it's doing is, it's opening doors for producers that can consistently deliver quality flower at scale, right? I think domestically, our reputation, our ability to do that, to consistently deliver quality flower on time and in full, I think that really aided our entry into Quebec. And internationally, look, we have no shortage of interested purchasers for our product. We're just going to take it slow, and our priority is to win at home. So we are really seeing it's driven by the flower, and then the other driver is innovation. Right? And innovation is an area where we shine. I think no team in cannabis has been responsible for more first to market innovations than the Auxly team. And that's certainly true in vape, where we've been responsible for almost every major consumption trend in vape, including recently last year, we introduced the all-in-one vape. It was a runaway hit. It won Innovation of the Year. It continues to dominate the vape market. Disposable or all-in-one vapes are the fastest growing segment of the vape market. And we're not going to stop, right? We're not going to stop innovating. We've already launched one of our main innovation bets for this year. It's exceeded expectations. It's our Back 40 backpackers pre-rolls. Summer is the right time to release a pre-roll innovation. That's exceeded expectations. We have a vape and a dried flower innovation coming still in the back half of the year. We're super excited about. We're not prepared to discuss them, but innovation is another key driver. Consumers want new products. They are still discovering. They're still exploring consumption. So I think those two things, the supply demand dynamics in flower, and some of the sort of offshoots that it's having, some of the consequences, and then just the importance of innovation continues to be a highlight for us.
Hugo, clearly you've been able to grow revenues nicely over the last couple of years here. If you talk about capacity and what you guys need to continue to do to grow, and is there M&A in that plan, I guess, as well?
Yeah, well, look, let me start maybe in terms of capacity and things like that, and maybe what investors can kind of expect from us. I think first and foremost, right, like we're going to finish H2 off really strong, right? And what we're trying to accomplish is year-over-year growth in revenue and profitability. And those two things kind of go hand in hand because we have a largely fixed cost base in our operations. So most revenue accretion will flow directly to the bottom line. But that's what we're trying to accomplish. So again, as I mentioned, to support our H2 push, we do have a couple of significant new innovations launching into market that we're really excited about. And so, you can see growth from that perspective. I think we are also now to talk about capacity and things like that. We set out this year, I think we produced about 90,000 kilograms finished flower last year. We set out this year to improve that output by 8 to 10% on a capital light basis. We're on track to meet or exceed that. And again, we believe that there are, a number of other CapEx light enhancements that we can make to our Leamington facility that will have an outsized impact on output, quality, and efficiency. Right now, we're right now evaluating our strategic options and our CapEx plans and what we're going to do for next year. And we're really excited about the options in front of us. It's probably a little too early or premature to comment on what growth initiatives we are going to pursue or a specific CapEx range. But what I can tell you is we do think that these enhancements will be CapEx light. We're going to be prudent. We're not going to get out over our skis in terms of like big spend or increasing output by too big of an amount. And we intend to fund whatever we do out of available credit in our cash flows. And then in terms of M&A, look, it's our focus is organic growth, but we're open to the possibility of inorganic, and we have explored it in earnest in the past. What I would say is we're a very small team. We keep things quite lean, so there is a high threshold for things that we're willing to allocate resources to consider. So we're going to be very discerning, right? I'm not looking to be opportunistic. I'm looking to be strategic. So I think in addition to being immediately financially accretive, right, we would also have to see a clear strategic rationale. And we would have to have very clear visibility on the integration and certainty as to synergies, right? I think what we're looking for would be like the type of certainty and visibility that comes from working with another party over a period of time. So it's not our priority. M&A is not our priority. It would have to meet a very high threshold for us to do it, but absolutely, it's not something that we dismiss or we're closed off to.
Mhm. Maybe it's sort of not necessarily ask the same question in a different format, but as you guys generate more cash, what's the capital sort of allocation thinking that you guys go through? Where do you want to move that cash? Is it pay down debt? Is it, organic growth, innovation? Where probably
Yeah,
all of the
so
above. Yeah.
yeah, absolutely. So we're, like I said, we're evaluating now
Mhm.
the mix of opportunities for the excess cash flow. We will prioritize capital investments, right? Because we think these will have an outsized impact on yields, output, quality, and efficiency. So we have a continuous improvement culture here. We're going to continue making our products better. They are consumer favorites now, but we're not going to stop trying to improve our moat of cost and quality. And then, as you said, we want to continue improving our balance sheet. So, we would look at allocating capital to our balance sheet, to growth initiatives, and measured on return on invested capital. We have a final piece of short-term debt. It's a $5 million inventory loan that comes due next month. It is very high interest. We have a very strong partner there, a very willing lender. But we're evaluating right now, as an immediate thing, whether it makes sense to pay that out, because it is high interest rate, and sorting that would save us about close to another $1 million a year in debt servicing charge. So compelling return.
For sure, for sure. Now, earlier you mentioned Imperial is one of your big shareholders. Maybe let's talk about your shareholder base. How much do insiders own, and any other significant investors you can talk to?
Yeah, so Imperial is our major institutional investor. They're our strategic partner. They own 19.9% of our shares. Insiders own somewhere in the 4 to 6% on a basic calculation. Fully diluted, insiders would own a little bit more. So we have been in market. Myself, I've been in market 3 times this year, buying shares when I'm not in blackout. One of our directors, also not in blackout, recently purchased shares. So we're excited about the future of the company, and we're putting our money where our mouth is.
Mhm. And your share price is bumped up here in the last little while. Just generally, are you getting more investor inquiries, or institutional players starting to ask more questions? What's the general tone out there of investors?
Yeah, absolutely. We're starting to see, and I think the fact that I'm on your show is proof positive of that. We are starting to see greater interest in the Canadian cannabis industry. I think there's a recognition this is the most mature legal market in the world. The industry has gone through a tough time, growing pains, etc. But there, thankfully, is a group of very solid companies that have emerged from that, have figured it out, and are posting consistently good results. So I think that has started to, get some investor confidence back into the industry. So we are seeing more outreach. I would say maybe it's still a bit too early for true institutional ownership. And look, in terms of the share price, we're happy with the performance over the last few years as we've implemented a much more focused strategy and turned the business around. But we acknowledge, right, like some of our shareholders have endured some tough times, especially, as I said, you can see it in our trough, that 2-year trough, where share prices were trading at all-time lows, and everyone had written Auxly off for dead. Right? And I think investors were rightfully concerned. We had a going concern uncertainty note on our statements. But again, we fought through it, and our thesis was that if we focused on gross margin dollars and got profitable as quick as we could, we're called default alive, right? Our future's in our own hands. And if we could methodically improve our balance sheet, our business could thrive, and investor confidence could return to Auxly. And we're really delighted to see that come to fruition and see our share price increase. We're up about a little over 240% over the 12 months. And again, I think we're just getting started here as well, right? I had the numbers run this morning, and I can tell you, we trade at a very low multiple relative to our competitive peers. Like we trade at about 8 times last 12 months EV to EBITDA. I can tell you some of the smaller names that, I think some of your investor base follows, you've had them on your show, they trade at higher multiples than that.
Mm.
And then if you look at our competitors, the people we actually compete with in market every day, Tilray trades at 28.2 times, right?
Mhm.
Village trades at 24.6. High Tide trades at 15.2. OGI at, close to 14 times.
Mhm.
So we believe, our thesis is that if we continue to focus on the business, improve the business, and we can post consistently profitable results, even better than Q2, which was outstanding, but if we can continue to win, in the business, that we will win investor attention and trust and be rewarded with an improved multiple, higher share price, and better liquidity.
Mhm. That's what we believe eventually happens. You guys, you run a business well, and investors like us notice. Um, Clearly, we sort of can recognize some of the challenges you faced, over the last several years. But maybe now the business clearly looks new, but it's changed. So, what sort of keeps you up at night now? What challenges do you face right now?
Well, let me start by saying that, given the significant headwinds, and the challenges to survival that we've
Mhm.
faced and overcome over the last few years, I would say, all of us are sleeping a lot better than we have in
Mhm.
the last few years. And I think overall, look, we're delighted with the progress that the company's made, right? The financial performance, the commercial performance, seeing our products win with consumers, seeing Back 40 become number one, right? These are all great things, but I think, I don't know if it's a worry per se, but what I spend a lot of time thinking about is really, how can we continue to live our mission every day, and how can we advance prudently towards our vision of global leadership, right? So effectively ensuring that we stay focused on our strategy, and then figuring out how I can best enable my incredible team to execute on our priorities, right? Like our mission is to help consumers live happier lives with quality cannabis products they trust and love. And we all believe in that. Like we all got into this industry because we love cannabis. We believe that the plant can make the world a better place, that it can help consumers live a happier life. So, are we consistently making high quality products? Because that low quality products don't help anyone live a happier life. Are we innovating to evolve with our consumers? Are we able to offer them excellent value because we're great and efficient at what we do? And am I able to get my products on the shelf across the country to make sure that I can deliver that product to the maximum number of people? So I think about that a lot. And then our vision is to be a global leader. And it's a very hot topic right now, a very
Yeah.
hot opportunity, as you can imagine. Lots of inbound inquiries, lots of investors asking us international, but it's not our immediate priority.
Mhm.
Our
Mhm.
immediate strategic priority is to win at home, because we think there has to be a reason to believe that you can take your brands and products and go to another country and compete effectively there. So I spend a lot of time with my executive team thinking about and discussing international markets, how they're evolving from a regulatory and commercial perspective, and how we might want to participate there, and then what capabilities are we going to need to develop in order to participate how we want to. So I don't think it's a worry per se,
Mhm.
but it's something we spend a lot of time thinking about.
Mhm. So I asked you sort of what keeps you up at night. Now I want to know what gets you up in the morning. What gets you the most excited, whether it's a new initiative, new product, new anything. What gets you up in the morning?
Again, I think it's all informed by the hardships we've endured. So for
Mhm.
me, the exciting thing, the thing I love most is the future, is, seeing my team thrive and continuing to grow, right? And the Canadian market is continuing to grow. It's growing at a very healthy rate year over year, 5, 6, 7%. Winning at home is our priority. So, gets me excited is I want to deliver H2, for our team, for our investors, make sure we finish off strong. We're innovation leaders, so I'm always super excited. When I get the stage gating report, and when I see the new products that we're coming up with to delight our consumers. And we want to continue increasing the depth and breadth of our distribution, including Quebec, which is a new market that we just got into, right? We've been there for about a year, having tremendous success, but it's going to take some time to build up to the share that we want, to build up to our fair share. Leamington is hugely exciting because I know what an incredible journey it's made in terms of efficiency, in terms of quality, and I know how much further we can push it, right? Like we haven't seen the best iteration of Leamington. It can get more efficient, it can get more throughput, it can get higher quality. So that really excites me as someone who loves cannabis, right? Is seeing the quality of our products continue to go up. So it's that, and then I'm excited by the international opportunities. I really, really am, right? I think we will participate, but we're going to take our time, right? I'm excited because I see the markets evolving. I can see the lessons that we've learned here and how to apply them in those markets. And look, we don't feel we need to rush into it because the Canadian market's growing. We're growing profitably here. Our gross margin is better than most of our peers that focus internationally. And we believe we're building real brands, real products that people love. And look, when the time is right, when we want to make a meaningful move, we believe we'll have the support of our partner Imperial Brands, who is a truly global CPG giant. They have unmatched capabilities in all of these jurisdictions that are evolving towards legalization, and we'll have a big brother to make sure that we're scaling effectively and efficiently in those markets when we decide to enter.
Very helpful to have a big brother. Listen, a handful of questions have come in, so why don't we tackle these questions and then we'll
Sure.
we'll let you get on your way here. Okay, we've got a question from Deep Patel, who says approximately how much have been invested into Auxly assets in Ontario and PEI?
Yeah, great question, Deep. And these figures are all going to be sort of estimates, but I can get you, with any of this, if there's follow-up, I'm happy to, get Travis on a call or just to get the answers and send them to you, Paul, and you can. So we have invested about, I'd say, over $40 million in our Charlottetown facility, not including the roughly $30 million we paid for it. And Leamington is very high capex. We've invested about $100 million in equity into it, and then we had a loan for about 80 million, which is now down to kind of 40, so about 180 million dollars, which when you think about the current context, the current capital market context, capital availability, only one of these facilities really highlights, when you start looking at the amount of capital that was spent on them, really highlights the moat, right? Like you can't raise $180 million today to build one of these facilities and take 2 years to build it, another 2 years to figure out how to really dial it in. Like there's no capital available for that. So yeah, we've made significant investments in those assets, but we feel that they are significant competitive advantages in the current environment.
You're absolutely right. Everybody we speak to is still loath to invest in any new supply out there right now. So that's still a challenge. Okay, what's different for Auxly that you guys are so good at vapes? If you could explain and share a few points. What makes you guys good at what you do?
Yeah, so I think first, we've been in vape since day one, right? So I think if you look back at the history of legalization and kind of the 2.0 starting line in that 2019 period, a lot of companies, most companies, were very focused on the dry flower market, and we strategically pivoted to the 2.0 market because we knew our cultivation facilities were not going to be ready for a while. So I think first and foremost, we have been in vape since day one, and we didn't just show up with a vape portfolio as an afterthought. We took a year to really like map it out. So I think number one, experience, right? No team in Canada has filled more vapes than my team, right? So they're good at what they do. I think number two is we really focus on quality. We don't buy off the shelf hardware, right? We design our hardware. We take it through extensive testing. When we launched all-in-one vapes, we'd been working on them for 14 months, right? A lot of iterations to hardware, a lot of iterations to software, the oil, making sure that the two work. A lot of sensory on the flavoring, on the plume, on the draw. So we take product development very seriously. We use custom hardware. And I think, as I said, I think the vape innovation team in Auxly, Charlottetown is second to none globally, right? So our ability to not only continue to push the boundaries on potency, flavor, unique extracts, and then marry that with best-in-class hardware. If you go to retailers, if you go to provincial control boards and you ask them, hey, what sets Auxly apart in vape? They're going to tell you quality. The lowest failure rates in the industry, lowest return rates in the industry. And that gives our customers and our retail partners a lot of confidence to put it on their, to stock it and put it on their shelf. So I think you couple all of that, and then again, we have tremendous route to market excellence. Right? We can manufacture, deliver on time and in full. So we've been very good at building very, very deep distribution across the country for our vape portfolio.
Awesome. Thank you for that. Okay, last question from Deep says, what's the maximum output you can grow or get, I guess, from Leamington post-expansion, and how much capital will require to reach full capacity?
Deep, I wish I could tell you, because I think we're examining those options now. Auxly Leamington we can expand it many, many different ways. From the sort of capital light ways that we're exploring right now to building out the second half of the glass, which would expand another 660,000 square feet of glass and more than double our output. Today, looking forward 10, 15 years, we're servicing a global market from Canada. We sit on a parcel of 100 acres owned land. The current envelope is about 30 acres, so we can double, triple, and we have the electrical allocation, the power capacity to expand significantly. But as I said, we're trying to get to 100,000 kgs this year, which would be about like 10-ish% improvement over last year. We're on track to hit that, and we think that there are further enhancements to push capacity well beyond that point without having to undertake like a major capex project to expand the facility more significantly.
Okay, so speaking of the facility again, Mark Merritt says, I forget how he phrased it, but he just described Auxly Leamington in strong terms. One of, was it most sophisticated facilities in the world? And Auxly Charlottetown is second to none. Can you expand on these comments? Why do you say those sort of things?
Sure. Let me start with Auxly Charlottetown. I will turn it over to Auxly. I think in Auxly Charlottetown, I think their track record, speaks for themselves, right? No vape team in the country has been responsible for more first to market innovations. I don't think, no vape team has filled more vapes with greater success. So they are very good at what they do, and it's the innovation function there that I think really stands out, right? And the track record proves it. So, and then in Charlottetown, maybe you're saying, well, why there? So maybe a little known fact, as our provincial governments maybe 15 years ago, especially in Atlantic Canada, looked to transition their economies away from, fishery and agriculture and tourism, the province of PEI really focused on biotech. And, started implementing conditions both through government support, a biotech alliance park, the creation of a government agency called the PEI Bio Alliance to support the biotech industry. And they've been very, very successful in attracting, significant companies, including, BioVectra, one of the world's leading biosynthesis manufacturer of API. And with that comes an incredible talent pool, right? So Charlottetown has the highest concentration of science PhDs per capita in Canada. And the QA talent, the science talent, the National Research Council of Canada has their dietary supplements branch there, right? Which is very consistent with the type of science you're looking for with 2.0 product innovation. So talent is exceptional. And I think, because of that talent pool, we're experiencing a lot of success in Charlottetown. With Leamington, why do I call it, one of the most advanced and largest? Well, largest is, I think, just numbers. It is one of the largest cannabis cultivation facilities in the world. Most advanced, I think seeing is believing. So it is a very, very highly automated environment. That's why we can get those incredible margins on flower products. It's a moving bed system. Nothing has been spared there. It is an greenhouse facility that from an environmental controls perspective is as manageable as an indoor facility. So there's lights, but apart from that, there is tremendous HVAC power in that building. So we're not controlling environment by venting and, using some of these more manual greenhouse methods. We are running that facility almost like an indoor grow facility with the additional benefit of sunlight. From a yield perspective, I think it is one of the highest producing facilities. From a cost perspective, if we're not the lowest cost producer, we're certainly, in the top 2 or 3. And then consistency is very important. And I think, that's always hard. We had to work really hard at it. We had to learn how to dial in and operate this facility. But I think if you want to look at consistency and what that means in our industry, look at potency, right? Look at potency and, how potency sort of fluctuates from lot to lot. And for example, I think right now in market, I'm seeing, some of the other large cultivation facilities putting out cultivars that have been in market for years. One of their original cultivars or, was recently in market, and all of a sudden they're like 8-9% higher THC, right? Like, so whether that is they did something to the cultivar, a new methodology, et cetera, whatever it is, there's like a lack of consistency. So you see these flutters. Whereas if you look at our output, yes, I think our products have gotten higher THC too, but that's because we're bringing in new genetics. They're entirely new cultivars, right? What you see is our cultivars are able to stay within a very tight potency range, and that gives consumers the confidence, right? They're not saying, well, I don't want the 20 whatever percent wedding pie because I'm going to wait for the 30 something percent wedding pie. They know it's always going to be relatively in the same range. And again, consistency and quality breeds trust and loyalty, right? And that's why our products stick around. That's why we have 7 of the top 30 SKUs in market.
Gotcha.
So I hope that answers Mark's question.
I think it's fantastic. Yeah, absolutely. Okay, next question from Sean. Sean says, "What is your goal for market share in 2 to 3 years? Do you think you can grow market share in this kind of environment? Is that the goal?"
Yeah, absolutely. We can grow it. I don't have a market share target because again, we tried that. We want to be number 1. We want a big market share. We focus on gross margin dollars. Are we growing profitability? And I think, if we focus there, we will put out great products and we will continue to win market share. So sure, absolutely. We want to win market share. I can just call up my business intelligence stuff here for a second, but I can tell you from like we are growing share over, a last month, rolling 3 months, rolling 12. I think as you start to see 2 phenomena, one, people will exit the market, right? This is a tough market to be in. As you said at the beginning of you can't say for a lot of companies that they're highly profitable. So it's a challenge. So you will see some companies exit, and then that leaves share available. I think, there are companies where, as I mentioned, like they have share, but it's kind of weakly held, right? And so we will, of course, look to innovate, fill white spaces and capture more share. So I think all of those things, we will increase share. I don't have a share target over the next few years, but whether it's organic or inorganic, we intend to increase share. And I would just point to something like Quebec, right, where we have very little share of market, but we are making tremendous. It's the third largest market, in Canada. They are big cannabis consumers. It's a highly profitable market, but we're just getting started there, right? We just got in about a year ago. We have very limited number of SKUs, but even with that small SKU count, we're really encouraged by the way Quebec consumers have responded to our product. Back 40 is the fastest growing brand in the Quebec market over the last quarter, right? With a very limited number of SKUs, 4 SKUs. It is the 4th largest brand in Quebec currently over the last 4 weeks. And our Fire Breath flower, which is the number 3 SKU total market, just entered Quebec, and it's already the number 1 flower SKU and the number 2 SKU overall in that market. So we're really encouraged by, this is an entire untapped province, and we're just getting started there. So yeah, absolutely, we're going to increase market share, but it is not the key metric that dictates if we're being successful internally.
Yeah. Well said. Perfect. Okay. Jill says, how difficult is it for Auxly to win new shelf space? How difficult is it to win shelf space for other smaller cannabis companies? This is, tell me if I'm wrong here. You guys obviously have a well-known brand in product with your Back 40. That must make it easier to launch new product. I mean, if you're recognized by the retailers and the different provincial organizations, having successfully brought a product to market like that, does it make it easier for you to launch new products and get that respect and early adoption?
Absolutely.
Yeah.
Absolutely. I mean, I think it's not just the brand and the product, and I think what gives retailers a lot of confidence, so let's say a new flavor of all-in-one vape, they know that vape is going to get trial. It's the hot new flavor from Back 40. Of course, everyone's going to want it. So they know it's going to get trial, but trial only gets you so far, right? And there's lots of ways you can encourage trial, but it's the repeat purchase, right? It's, did you delight the consumer? Did you give them great value? Did you meet their expectations? And I think that's really, again, 7 of the top 30 SKUs in market, Back 40 SKUs, right? So if you're a retailer, you bring Back 40 into your store, you're going to sell, that consumers are looking for it. And, with a product, for example, like our Back 40 Slims, the number 1 non-infused pre-roll in the country, right? That is a key basket builder within most retail locations. They come to the counter, they're buying a vape, they're buying something. It's like, hey, do you want to throw in a pack of Back 40s for, $20, 20 something dollars? It is, so retailers love it because we're giving them a pathway to making more money. And I think that's let me stop with, we've got great products, we've got great brands that people trust and love. So yes, they want them in, it's easier to get listings. But it's important when I say people trust and love our brands and products, not just consumers. Our customers love our brands and products too, because they know that we are going to consistently deliver quality products that they can count on. So just like, retailers want to know that when they order, they're going to get it, so do provincial control boards. So our ability to consistently deliver quality products is very important in giving new listings. They know that I'm not going to, well, I got an opportunity here, so I'm going to shortchange you so I can go fill it. We meet our fill commitments. And then our level of sophistication in route to market, I think, is unmatched in the industry, right? We've invested heavily in data and insights. I think we have the best data platform in the industry. I can see all of the data in real time, every single SKU in the entire industry across the country. So we're very often able to go to our provincial control boards, and we just don't show up with a product and go, we think it's cool and it's back 40, so you should take it. We show up with insights. We show up with, hey, this is our product. This is the proposition we were going for. Here's how it fits in. Here's how it fits into your assortment. Here's how it fits into the consumer behavior profiles that we're seeing. So we go in with real data. We give our customers the confidence they need to stock our products, and then we give the retailers the tools and confidence they need to really sell our products with confidence. So our route to market excellence, I think it's unmatched in the industry. And look, the performance justifies, as I said, we're doing it with way fewer SKUs than the competition. And I think one of the things that sometimes surprises people when I talk to them about Auxly is they think we're this, big, massive company with like thousands of employees doing this. We're 410 teammates strong across all our 3 sites, headquarters in Toronto, Charlottetown, and Leamington. We just punch way above our weight because we love these products. We take our time, and we're really focused on consistent quality.
Gotcha. Okay, next question comes from Deep. He says, if you could share how management is incentivized on what metrics they're awarded share-based options and DSUs. I mean, you guys have gone through the trenches or the trough or whatever we want to call it. How do you maintain a sort of an incentivized management team?
Yeah, no, look, that's a great question. I think it's a good question. So we look, we have a compensation committee, and we set annual goals, and then our incentives are based off of our annual corporate goals, based on how much of our goals we hit. Over the last couple of years, we've done a little bit better. Our goals are things like, that tie into our strategy. So for this year, for example, our goals would be a top line goal, right? We want to make sure we're growing revenues, a cash goal, because we want to fund growth and we want to improve our balance sheet. So cash generation is very important. A debt to EBITDA goal. We want to improve our balance sheet. So couple ways that various ways that we can get there, but the compensation committee wants to make sure that we're reducing overall leverage, and a share price target, which is something new for us. We haven't always had it, but as we're seeing greater stability and renewed investor interest, the comp committee felt it was appropriate to really sort of align our comp incentives with share price appreciation. So there's a share price goal as well. And I think when you look at our competitive peer set, right, which is what our compensation committee looks at. And when you look at, the companies that we compete with in market every single day, the larger producers that are running large commercial businesses, and you look at our total executive compensation, you'll see that we are median or below median. And even as the company's performance has improved and total comp has improved, we've remained at median or below median. In terms of the RSUs and the incentives, I think there's probably a little bit of context, and then like a little bit of nuance that probably will benefit investors. I think in terms of context, and I think this goes for every year since Auxly has started, our executive team has always deferred and or accepted equity in lieu of earned cash compensation, right? Like every other company, we have our base, then we have like an annual cash target, and then longer term incentives. But over the last number of years, when the company has really been up against it and needed cash the most, the executive team and directors have always voluntarily agreed to accept equity compensation, deferred equity compensation, in lieu of earned cash incentives. So I think that's why if you look at kind of our neo comp, right, you see equity compensation increase disproportionately to cash compensation. That's because, even though at the time, I think, the market was had a lot of apprehensions about the share price, and I think everyone operated with the understanding that there's a very real possibility that we don't make it. We wanted to keep the cash in the business. That's where it was needed most. So there was no capital available, external capital. So we took equity, we took deferred equity compensation in lieu of those cash bonuses. So that kind of, I think, is the context for why we have a big pool of RSUs issued. And look, like I think I certainly can understand shareholders looking at that and having questions, but I think in hindsight's 2020. And I truly believe that we did the right thing at the time. And I don't think a hired gun executive team does the same thing. I don't think they say, hey, even though the company is really like a strong risk that they don't make it, don't pay me the cash you owe me today. Give me equity that you can settle up in 3 years. And then the piece of nuance, I think, relates to that. And that is, a big chunk of the executive RSU pool, about 50% of it actually, is, relates to these RSUs that were issued kind of in 23. You can look at them in our disclosure. They're called cash settled RSUs, but those were issued. Again, they were awarded at a time when we didn't want to take cash out of the business, so we agreed to take equity in lieu of the cash. But we also recognized that we were issuing a lot of RSUs and that this could have an impact down the road when we had to settle them. So we capped them. Those RSUs are actually capped. They're capped at 2x their value on the issue date. So on the issue date, we were trading at about like 1.7 cents a share. So these things are capped at just below 4 cents. So when you think about the settlement of those RSUs that happens at the end of this year, the amount of shares that will be issued, it's not 1-to-1 for RSUs, right? So think about, just assume that there's 80 million of these RSUs, which don't hold me to that number, but it's probably not far off, right? And say our share price is 14 cents, which is, or 16 cents, which would be 4 times, just keep an easy math here, Paul. But that would be 4 times the capped value of those RSUs. So if we did settle those RSUs with shares, it would be about 20 million shares issued, about a fourth of the RSUs. So that's the nuance, right? Is that we agreed to take equity in lieu of cash. We agreed to defer it, and we knew that it could create a problem later on, so we capped it at 2 times the value. And again, I think only a founder-led executive team is going to agree voluntarily to do that. But we have done that consistently every year that Auxly's been, because we recognize that, hey, look, it's frustrating for shareholders to look at executive compensation that they feel is high in the circumstances of a company and share price that's struggling. But I think the nuance and the context is important, because I think our battle-hardened executive team is a competitive advantage for Auxly and highly aligned with shareholders. And I think we're fairly compensated relative to our competitive peer set. And I think that over time, we are going to prove to be excellent value for money.
Awesome. Okay, question from Russell. Russell says, do you carry past excise tax debt? If so, what is the value, and is there a payment plan in place?
No and no. We are fully current on excise. In fact, we actually, we're trying to close the refinancing at the end of quarter, before the end of quarter. So we're really pushing to be able to reflect those pro forma results on our statements. We didn't get it done, but we actually, paid some of those liabilities early to try and get it done. So no, we're fully current. I actually just saw the cash report today go out, $7 million in monthly excise out the door. So yeah, look, it's a challenge for sure, but it's one of the hardships that we have learned to deal with.
Yep. Very valuable. Okay, Jill says, a product question here. On average, how long does a plant remain on the balance sheet as inventory before the end product is shipped to a retailer?
Jill, that's a great question, and I'm going to defer answering it because it's really a Travis question. I will say this, like, we have a pretty quick turnover of flower, right? So there is a very strong demand for flower. So there will be like natural processing, right? Drying, curing, trimming, packaging. There will be a period of time that it's in supply chain. But in terms of kind of inventory sitting there, building up, we've gone through that hardship. When we started turning the business around in 2022, I had $50 million of inventory. And one of the things that saved the company is we managed to convert a lot of it into cash. But so we try and keep inventory pretty light in that sort of like low 20 million range, to make sure that we always have product to fill. But we don't want to take a big risk on building a lot of inventory.
Perfect. Okay, Shai, there's a couple questions from Shai here. We'll start. As a business operator, when considering which companies are likely to become the most successful over the next 5 years, what do you see as the key differentiators between the winners and the rest?
Focus and discipline. Easy. That's what's
Simple.
worked for
Yeah.
that's what's worked for us, right? I think we started off as a company that wanted to be in every 2.0 format. And we spent money and we built capabilities to do all that. We were in everything. And we were having a lot of commercial success, right? At the end of 21, we exited that year with 7.4% share of market. We were the third largest producer then. We were having a lot of commercial success, but we weren't having financial success. We lost $17 million that year. $17 million negative in EBITDA, and put the company under real pressure when we took over the Leamington facility. And it's that mentor once told me, he said, when you're hungry and homeless, you're not worried about anything but shelter and food. And it's the same thing when you are down and people think you're down for the count, right? You're homeless and hungry, and you need to focus on what matters. So I think that focus, that discipline is really will set the winners apart.
Not to disparage any of the companies out there, but I get the sense that you're right. Being homeless and hungry makes you focus, but there's still some big players out there that I don't think they've ever gone hungry. They've always had a lot of cash. I don't know how sharp their pencils are. Do you think that's a fair statement?
Yeah, I think it's a fair statement, and I welcome it.
Yeah, good.
Yeah.
It helps to be humbled and hungry every now and then. It sharpens the focus, right? Yeah, absolutely.
Absolutely, yeah.
Yeah. Okay, here's an interesting question from Shai again. It says, if you were to build rather than buy, which core competencies or assets do you consider easier to acquire than to develop from scratch? And I guess, and second part, and has your perspective on the build versus buy decision evolved over time? And if so, how? I mean, it sounds like,
yeah,
I mean, you were
it's a
pretty clear in your
great
answer.
Great question, Shai.
Yeah.
And I think the hardest one to buy is cultivation. And I would build it, because when Peter, our JV partner, built the facility and built us a great facility, and he was an expert and left us lots of good staff and things like that. But building a facility and then dialing it in is a very involved process. It takes a lot of people working together with a common goal, right? And look, people have different perspectives. Growers have different perspectives than QA, different perspectives from manufacturing people. So it really takes an entire team. So I think cultivation for me, large scale cultivation, would be the hardest. Even small scale cultivation, we haven't always been successful at it. In terms of buying, what would we buy rather than build? Again, we really like our own assets because they're purpose built and we see the benefit of it. But I don't think you necessarily need to own extraction at this point. So maybe I wouldn't have built that in Charlottetown, right? It was originally had a lot of extraction output. I think it is an important capability. I just think that there are lots of good, people out there now that do it and do it effectively. So for me, it's like the thing that you need is cultivation. It all starts with the flower, even for extraction, right? Like you have seen prices for biomass go up, so that includes trim. We produce an incredible amount of trim at Auxly Leamington, and it's high potency trim, which is even more valuable because no one wants low potency, distillate or extracts. They want high potency, and if you don't start with high potency trim, your costs on that are gonna get out of hand. You're gonna have to do multiple passes. So that trim is in high demand, and because we have such large volumes, we're able to work collaboratively with extractors and get great pricing on our inputs.
Hugo, in your view, do current valuations make your shares a viable currency for M&A? Alternatively, if you consider the shares to be significantly undervalued, would you pursue a large-scale repurchase program?
So I think I answered the undervalued question already, right? We're trading at an 8x multiple last 12 months EV to EBITDA. My competitors are trading 14 to 28 times. So yes, I think we're undervalued. I think, but again, I understand the apprehension, right? We just removed our going concern uncertainty note, and we're going to work hard to win that investor confidence over the coming quarters. So yes, I think we would be undervalued. I would not want to use, again, our equity at this point. I think the cost of that capital is high. If we had to use it for a very, very, good strategic reason, we'd want to minimize that use. Sorry, what was the second part of Shai's question?
Would you consider repurchasing your shares like a share buyback?
Yeah. Look, I never want to say never to the option, right? Like I think there are instances where it could be appropriate if that's the highest return on your capital. But I also don't want to set the expectation that, we're going to pursue a buyback in the near term because it's not in our thinking. We believe that Auxly shareholders will benefit most from us allocating capital to growth and continued balance sheet improvement in the near term, right? And I think, again, like we're material shareholders, we've been out in the market, and so like we believe we're just getting started and that those are the right priorities to best serve shareholders. But, in the future, if we've got excess cash and our balance sheet's all cleaned up and growth opportunities are not going to provide as good a return, we would consider it. But and we'll continue to evaluate, but it's not in our near-term thinking.
Gotcha. Okay, two more questions, and then we'll wrap it up here. Shai says, looking at trailing quarterly operating margins, I see a steady increase from 16% to 25%. From your perspective, to what extent is this improvement driven by cyclical factors versus structural and secular changes? And if the latter, where do you believe operating margins could reasonably scale to over the next 3 to 5 years?
So I think some of it is cyclical, right? Some of it we've already talked about the pricing increase. I think like we're very constructive on pricing over the near terms, but it could be cyclical. We could see another period of price compression. We don't foresee it in the near term, but it's a possibility. So I think some of it is that way. But look, like I think a lot of it is structural, right? Because we focused on 3 formats, right? And then our capabilities are all 100% tailored to being the best and the most efficient at those formats. And I think that's why we don't look at quarter over quarter because of the seasonality in our business. We don't look at annualized anything because of the seasonality in the business. We look at trailing 12 months. That always is going to capture the seasonality. And over the trailing 12 months, we've been operating at a 50% gross margin, and we've been operating at 27% EBITDA margin. So to me, those are strong CPG style metrics. That's where we're going to try and aim to be in. But as I said, as we continue to improve and enhance Leamington, as we continue to increase yields, increase our revenues, a lot of that will go to the bottom line because of the cost base is largely fixed. So we think that we can still get better. As I said, we aim to be better every single time. That's one of our corporate mottos. So we're going to continue to look for ways to enhance output, enhance quality, enhance efficiency, and stay within those ranges or better.
Mhm. You may have answered this last question, but I'm going to ask it anyway. Shai says, do you believe Auxly is under earning on certain key corporate assets such as brand with further pricing power, proprietary know-how that has not yet been fully monetized, distribution or scale advantages that could drive future margin expansion or unique customer loyalty? And if so, how do you assess the magnitude of this under earning?
So I would say, I don't think we're under earning. Right? I think this is something, pricing, volumes is something we analyze, every single day, hourly. Like, right, we have people that's all they do. And I think, it's always it's a balance between, price, profitability, and volumes, right? We have a large scale cultivation facility. We need to move volume, right? And our consumer, if you think of our mission, is we want to help people live happier lives. That's not just like some people. That's not like, bougie people, or like, it's everybody. We need to make our products accessible to everybody. And that means offering tremendous value, and not just value, but consistency. We tell our people every day, like, life is expensive. So imagine spending $130, $140 on this product of your hard-earned money and getting home and it doesn't meet your expectation. That would be devastating. So we really focus on offering great value. We took some price this year, right? There was a price increase, so we took a bit of price on our ounces, and we didn't see any drop off in volume. So pricing is something we look at all the time. I can't quantify whether, I could squeeze out another million or $500,000, because, we've got to consider volume, and we also have to consider, our strategic objectives. So in terms of, can we be more strategic in terms of SKUs? I think we always look for national distribution, right? We want our products across the nation, but I think as markets evolve, you're seeing some of it right now, right? Like we won one of the vape SKUs in Quebec. And that is a very different product, right? That is a 30% THC cap product. It's not something that's in our current lineup. So you have to kind of go and innovate. So in the future, there could be more sort of regionally focused SKUs and things like that. But right now, again, our focus is being the best at pre-rolls, vapes, dried flower. We've already introduced a killer innovation, right? The 0.75 straight cut backpackers. It's been the smash hit of the summer of pre-roll that Ontario is running, and we've got a couple more innovation, and we're not going to stop, right? We're not going to stop. We are going to continue being innovation leaders, continuing to evolve with our consumer preferences, and give them new and exciting products that they can trust, because they'll know that it's going to be consistent quality.
Mm-hmm. Well, listen, Hugo, congratulations. I mean, phenomenal turnaround of the business here, and clear success here over the last couple of years. So well done. As investors on our side of the table here, what do you think we should pay the most attention to, either metrics or catalysts going forward that really indicates you guys are still sort of hitting it out of the park?
Yeah, look, I think look at continued revenue growth and continued growth in profitability. That's what we're trying to achieve. And I think, that's going to be net operating revenue, right? Because as I mentioned, like, if we're growing revenue, a lot of that is going to flow to the bottom line, given our fixed costs. Gross margin and EBITDA margin are things that we track, and investors can track too. That's to ensure that we're remaining operationally efficient and also disciplined in our spending. I mentioned trailing 12 months, we're operating at 50% and 27% respectively on those margins. And then, of course, cash is king, right? There's no capital available. Whatever capital is available is very high interest, highly dilutive. So operating and free cash flows are obviously very important because we want to invest in growth. We want to continue improving our balance sheet. And we got to do that out of our cash flows. And ultimately net income, right? As I said, over the past 12 months, we've generated $28.1 million in net income. There's an $8.1 million amount that relates to a one-time recognition of a sort of tax deferral. So, we think we'll probably have another one-time hit, like one-time accretion to net income in Q3 because tied to the Imperial conversion, because we effectively bought $9 million worth of stock for $21 million. But even with the exclusions of those one-offs, we're generating significant net income, right? Like over 12 months, $20 million, and thankfully, we can shelter that income, right? We have about $200 million in available losses to shelter that income going forward, which again really gives us the financial strength to continue investing in growth and improving the balance sheet.
Yeah, fantastic. Was there any questions I should have asked that I didn't? Is there any message that that we didn't get a chance to talk about? What do you think? And if not, like, what's the key message you want everybody to walk away with today?
Yeah, look, I think first of all, thank you for asking the questions, and I'm very happy to be here and be able to answer those as best I can. I think, look, what I would leave investors with is we've built a business with strong foundations for growth, right? And we're really just getting started. I think the business is operating and performing like a CPG company. We've got the #1 brand in Canada, Back 40. We're innovation and category leaders in those key product formats that we focus on. We've got distribution in 97% of all retail locations and strong efficiency and profitability. So, I think that's exciting, and the recapitalization makes us very excited about the future because it changes the way we look at strategy, right? We've gone from effectively survival mode, operating, pay down debt, right? Like survive, to now really looking at how we're going to grow, right? Investing in growth. We're going to continue improving the balance sheet, but we believe there's many options for strategic investment that could yield really high returns and strategically improve our business. So, we're growing profitably, and now we have the balance sheet to make, relatively small investments, but that will really improve output efficiency and quality, and continue to grow revenue, improve profitability. So we're really excited for the future. We think we're just getting started. And I'd be delighted to be back here at another day to give you an update on how we're progressing against those goals.
We're going to take you up on that for sure. We'd be happy to have you back. We've been speaking with Hugo Alves, CEO of Auxly Cannabis Group, symbol XLY on the TSX. Hugo, great to catch up today, and certainly congratulations, and we look forward to the next time we get a chance to chat.
Thank you very much. It's been a pleasure, and thank you to your listeners.
Appreciate it. Thanks, and bye for now.